Hello, everybody, and welcome to the Tortoise channel once again. Today, I want to delve deeper into Pinterest, and I want to discuss why I would not put a single penny on this company. Okay, don't take it personally. Of course, that's not the point here. I always talk the facts, and I'm very straight. And the reason I'm saying this is because um, I'm sharing my point of view, okay? And my goal with videos like this one is to walk you through the reasons why I would never invest in certain companies, okay? The main reasons are that they simply don't meet my quality criteria, and so I have to say thank you so much for who's his name, Whitey Hood 7. So he commented, as you can see right here, hey, do you think Pinterest is a buy at these levels? And so the straight answer is no, I don't, and it wouldn't be a buy at any level if you ask me, because I'm a long-term investor, and so today I wanna walk you through the main reasons why it's a hard pass. Okay, but first things first. Thank you so much for that support, for that feedback, and for mentioning, yeah, for talking about, for just leaving a comment, saying something constructive. In this case, you were just asking me to analyze this business, and I'm going to gladly do so over today's video. Okay, and if you find it insightful, you and everybody else, please smash the like button and share this with people that you think can find it beneficial. Okay, so I'm not sure if I'm going to detract you from making an investment in Pinterest. The goal of this channel is not to provide financial advice. Instead, we are trying to provide financial education here, and I'm telling you exactly what I would be doing with my money since you asked me my opinion. Okay, all right. So the reason why I see red flags, number one, the first thing you can see is that according to Stock and Log, the company gets a 4.13 score out of 5, which is very, very good. So what's happening here? All right, why am I bearish on this company? The reason is, first of all, I think we all know Pinterest, right? So it engages in the operation of a pinboard style photo sharing website. The company is headquartered in San Francisco. They went IPO on 2019. Typically, I like to see 10 years worth of data because um, I want to see a track record of a long track record of profitability and consistency in the numbers. So that alone will fail that test, but I'm not too picky about it. 2019, that's what, 7 years. So yeah, that wouldn't be a reason for me to exclude the company, but it's certainly not ideal. Okay. The company's primary service, Pinterest, can be accessed through its mobile application or the web. People use it to find ideas. And so you can find more details about the company right here, but they operate. This is the industry, interactive media and services, and the sector is communication services. What I notice is, so let's have a look at the financials. And again, some of you will certainly know Pinterest better than me. I can only speak in terms of the fundamentals and what I'm seeing across the balance sheet, income statements, and cash flow statements. But this is just part of the work. All right. So there's a lot more to it there's a lot more that goes into analyzing a business properly. However, just by skimming through the financials, I would not waste any single additional minute studying the company. And the main reason for that is, if I go here to the income statement, you can see that total revenues have been going up sharply at about 33.85%. That's solid growth. Okay, so revenues are going up. But if you look at earnings, boom, this is what you see. So earnings going back to 2017, look at that. Across many periods, they were actually negative, and now you saw this jump. So I'm going to ask you this: do you see any consistency and predictability in the earnings, in the profits that the company generates? The question is no. Also, I don't like to see negative figures. I don't think I will ever invest in a company with negative profitability. Right? It's just, it goes into my too hard pile. again, I keep emphasizing this, and I will share it with you once again. Why would you aim for companies that are not profitable when you can make a lot of money in well-established companies that have proven track records? Okay, so this is just like shooting in the dark. I don't know. It may very well be the case that Pinterest is going to perform exceedingly well over the next 5, 10 years. I couldn't care less, because investing is a probabilities game, and you want to have the probabilities heavily stacked in your favor. Now, with this profitability record, I just don't have that. Okay, so I would just stay away from it. That's one thing. So look at that. No compounding because earnings have been negative, as I just said. So I don't like this. Okay, that's red flag number two. That's yeah. And so if we go here to total assets, I can see that assets are going up. Okay, so that's 24.16 CAGR. That's good. What about current? What about total liabilities? Okay, so total assets have been growing faster than total liabilities, and the result, we have book value per share increasing, which is always good to see. So what about cash and cash equivalents? They have about 1 billion. I can see total cash. They have about 2 billion and a half, and I can see so total debt. They don't have long-term debt and they don't have short-term debt, which means they have a current cash position, a net cash position. Okay, this is very good. And in fact, if I go here to Pinterest current stock analysis, you can see, if I scroll down to the balance sheet, you can see that they have indeed a net cash position. So this is exactly what you will want to see ideally. A pristine balance sheet. There is nothing to say about that. I really like that. Okay. So yeah, nothing to say in that regard. And sure enough, if you look at the financial position of the company, you can see that across debt to equity, EBITDA, and free cash flow. Look at that, because they have little to no debt. You can see that. I mean, yeah, there's no problem. They won't have any problem meeting their short-term or medium-term or long-term obligations because of that. So I like to see. I love seeing that. All right. But the problem with Pinterest is in the cash flow statement. When I go here, I can see that cash from flow from operations has jumped sharply from 2020. Okay, so this is something that I like to see. But take a look at the stock-based compensation. Guys, you have to pay attention to stock-based compensation. So what I learned from going through Pinterest financials is that the only reason that you have a positive free cash flow, and someone who is an amateur just looking at this chart will say, oh wow, look at that, the company is so, I mean, is so cash rich. Look at how much cash the company is generating. But the problem here, guys, is that so you have negative net income, right? In fact, you had negative net income in 2022 and 2023, while the free cash flow was positive. So what the heck is happening? What's happening is that stock-based compensation is added to the operating cash flow. So if I go here, just look at that. Okay. So look at this. In 2022, 2023, you can see that net income was negative, as I already discussed. However, if you look at the stock-based compensation, look at that. 647 million in 23, 497 million in 2022. So when you add both, when you had stock-based compensation to the cash from operating activities, of course, free cash flow is going to be positive. And that's exactly what we witnessed right here. However, because remember, stock-based compensation is a non-cash expense, and because of that, it's added back to the operating cash flow. However, what we see right here, what you have to understand is that stock-based compensation is a cost for shareholders and should be treated the same way. And so when you see a company that is doing a lot of stock-based compensation, when you look at the free cash flows, make sure that you exclude the share-based compensation from the free cash flows. And if you do that, what will you have? You will have negative free cash flows. in 2022, 2023, and you will see a much lower number in 2024. So what these little pigs are doing is they are paying themselves a lot of money via share options, via share-based compensation. Okay, and in fact, if I go here to metrics and if I look at the percentage of share-based compensation, look at relative to operating cash flows and revenue. I mean, just look at this. Share-based compensation as a percentage of operating cash flow. This is in 2024. Okay, is, let me see, 79.39%. I mean, I don't even know what to say about this. As a percentage of operating cash flows, as a percentage of free cash flows, you see 81.47%. Now, if you look at 2022 and 2023, of course, the share-based compensation as a percentage of free cash flows exceeded 100%. So, look, guys, these guys, I mean, I don't like this. Okay, certainly I just don't like the fact that these people are paying themselves a lot of money when they should be using more cash incentives, all right, instead of share-based incentives. And if I go here to financials again, let's go here to the income statement. Look at the diluted shares outstanding. The diluted shares outstanding increased almost 50% since 2017. Another red flag. I like to invest in companies. If you look at the companies in my portfolio, which I discussed at length in several videos, I only like to invest in companies with a declining share count. Certainly not an increasing share count, and especially considering that the share count has been increased by almost 50%. Look, maybe they've done some acquisitions, right? So they are embarking on an acquisition spree. They are issuing shares to borrow funds via equity by diluting existing shareholders. And maybe that's what's causing the revenues to go up. So if you are in the business, if you know the industry well, you have to understand why have they decided to issue so many shares since 2017. Was it acquisitions? Yeah, and are those acquisitions creating value? So as there have been synergies with Pinterest's business segments. So this is what you have to understand, all right? But for me, it's definitely a hard pass. And in fact, if I go here to insights, okay, so I discussed that the financial health is stellar. I'm pretty sure that the growth should also be not good. But then this is the problem: is really management and the fact that they seem to be acting as little pigs, destroying shareholder value. And sure enough, the reason I also say that is because if I come here to cash flows, you were telling me that the stock might be cheap right now. Well, if it's and when I say you, I'm referring to again to White Hoodie. Again, thank you so much for bringing Pinterest to my attention, because I always like to discuss to give these examples to our audience. But you can see that the net common stock issued is is actually so it's declining. We want to see that because it means that they are buying back stock. But the problem is that the share buybacks are not being enough to offset the dilution that the company is currently going through. Okay, and so they are effectively destroying shareholder value. You'd better make sure that whatever it is they are doing is going to create more value in the next 5 or 10 years. I have no idea. Okay, but this is not a company that meets the criteria for quality, and so it would be a hard pass. And for example, and what I would like to see in terms of earnings is I would like to see earnings growing consistently since 2017, and I would like to see at least 8 to 10% growth compounded in the earnings. I'm not seeing any of that. Okay, so I look at this, I don't see any consistency in the numbers. guarantees that the numbers are going to follow, like are not going to be down sharply, for example, in 2 years from now or 3 years from now? I have no idea. Okay, this looks like a company that is far from well established. It doesn't. I don't even know if this company has a moat, and so certainly the numbers are not telling me that. And of course, if you look at the margins of the business, you can see that gross margin so remains, the average is about 73, but this is a capital light company, so I wouldn't expect anything else. But you can see, of course, look, operating margins, not bumpy, of course, makes a lot of sense. Same thing with net margin. Look at that, nothing. You can't make sense of these numbers. You don't just see any consistency. It makes it very hard to predict whether the company will be in, say, 5 or 10 years. And to top things off, remember that you have to exclude share-based compensation from the free cash flow. And so if you do that, what will happen is the price to adjusted free cash flow, which currently stands at 15, yeah, will all of a sudden jump sharply, because the free cash flow, when you account for the share-based compensation, is not as good as it seems. Okay, make sure you take that into account whenever you are doing your valuation. And so, but now answering to your question, no, I wouldn't invest in the company, and I would say just look. I, Not financial advice. I can only mention that I wouldn't invest in the company with my own money. Okay, so just go back to some of our previous videos, and you will see that we are all about finding great companies trading at a significant discount to their real value. And certainly Pinterest doesn't meet the criteria for quality, and it doesn't even meet the criteria for cheapness, because remember what I just said. Okay, you have to consider stock-based compensation. And in fact, let me have a look at this here. If I go to the let's see, do they have the adjusted price to free cash flow? Valuation relative right here. I see the price to free cash flow. Yeah, no, they don't have the adjusted version right here. So yeah, man, look, it's a hard pass, okay? But I hope you managed to find the video educational. That's certainly my goal. And again, thank you so much for telling me to discuss Pinterest. Whether it's a good company or a bad company, this is something that I want to do unfiltered. Okay, no biases here. I will tell you exactly what I see, and hopefully this will allow you guys watching this video to make sound investment decisions going forward. So if you find it insightful, just let me know in the comments below. Okay, I hope I managed to help you, and I will do. Some of you shared more companies for me to analyze. I've already noted them down, and my goal is to create separate videos on each of them next week and beyond. So stay tuned for more. And again, don't forget to share the video with someone that also loves the markets. Last but not least, guys, the second live video, so ask me anything. I will be live once again on the 31st of January after a very good experience the first time. And so it will be awesome to see more of you on that call, and you can ask me everything investing related, whatever you want to ask me. Okay, it's just about you can ask me anything, investing, wealth, in life overall. Okay, so guys, have a great rest of your day and stay tuned for more.